You know, in this business of speculation, most folks are always in a hurry to catch the wave after it's already crested. They want proof, confirmation, a crowd cheering them on. But the market doesn't work that way, and it never has. And as we get into today's idea of catching financial waves before they start, it naturally ties back to the previous video on how to find big moves first, because the trader who waits for the newspaper headline is already late. Now, let me tell you something I learned early. A market move doesn't begin with noise. It begins with silence, a subtle change in tone, a shift in pressure. The tape whispers before it speaks. And if you, as a trader, aren't listening for the whisper, how will you ever hear the shout? Ask yourself that for a moment, because every big swing I ever caught started with something small, something most people ignored. People imagine waves as dramatic, rolling giants. But on a price chart, the early wave is often just a little tilt in the slope, barely noticeable unless you've trained your eye. You ever watch how a stock stops falling, even though the news is still bad, or how it refuses to break down when it should? That's the market hinting that the selling pressure is drying up. And do you know what happens when selling dries up? Buyers eventually step in, and the wave begins to form. But many traders are too impatient to wait for that quiet moment. They want action. They want excitement. They want to see the big candle before they feel safe. Yet by the time that candle arrives, the smart money has already positioned itself. I've always said, the market pays the patient and punishes the impulsive. And if you don't believe that, take a look at your last handful of trades and ask yourself whether you acted on proof or on understanding. Catching waves before they start isn't reckless guessing. It's disciplined observation. When a stock stops going down on heavy selling, that's information. When volume increases but price doesn't break a key level, that's information. When a trend line gets tested and holds for the third or fourth time, that's information. These small clues are the market's way of telling you something's brewing. And don't you think it's better to be early for the right reasons than late for the obvious ones? But here's where the money mindset comes in. Most traders can see the clues, but they don't trust themselves enough to act on them. They think, what if I'm wrong? And that fear keeps them from catching the early part of the wave. So they buy late, at the point where their fear turns into hope. But hope isn't a strategy, and it isn't a mindset that builds wealth. Tell me honestly, how many times have you hesitated until it was too late? The way you think about risk is the real foundation of your trading. When you learn to risk small when the wave is still forming, you give yourself room to ride the larger move when it breaks. I used to say that a speculator's job is not to predict but to recognize. Recognition happens early, prediction happens in your imagination. And there's a difference between reading the market and wishing it would behave a certain way. So ask yourself, are you reading or are you wishing? Some of the biggest profits I ever took came from positions that looked dull at first glance. No fireworks, no headlines, no excitement. But they had something much more valuable, quiet strength. A stock that refuses to drop is often stronger than one that leaps up for a day or two. And when you understand that, you begin to see waves before the crowd sees water. That's the difference between operating like a trader and drifting like a gambler. Now, you might remember from the previous video that the best moves reveal themselves early through structure, not sensation. Today's principle ties right back to that, because early waves show structure, support forming, resistance cracking, volume shifting, long before they show the kind of price action that the untrained eye chases. And if you can read structure, you don't need excitement to confirm your decision. When I say early market waves begin with subtle shifts rather than dramatic moves, I'm talking about the kind of changes most traders never bother to look for. They're too busy waiting for fireworks, big candles, price spikes, news announcements, or some analyst shouting from the rooftops. But the market doesn't announce its best opportunities. It hints at them. And if you want to be a trader who gets in before the wave rises, before the crowd notices, and before the chart becomes obvious, then you have to train yourself to recognize the slightest tilt in the behavior of price. These subtle shifts are the birthplace of every real move, and the trader who overlooks them ends up chasing what could have been caught earlier with less stress and more clarity. You ever watch a stock that's been declining steadily, day after day, and suddenly you notice that the downward pressure starts to slow? It doesn't reverse dramatically, it simply stops falling with the same force. The candles get smaller, the volume dries up a little. The panic selling fades. Most people don't even give it a second thought. They assume it's just a pause before another leg down. But sometimes, that pause is the first whisper of a market that's getting tired of falling. And if the market is tired, something new is preparing to happen. That's the kind of subtle shift you want to notice. The quiet ones. When a wave begins to form, it often feels like nothing is happening. The stock doesn't explode upward, it simply stops reacting the way it did before. Think about that for a moment. If a stock has been dropping and suddenly stops reacting to bad news, that's meaningful. Or if a stock has been rising and suddenly stops making new highs despite good news, that's meaningful too. These are the small, nearly invisible changes in character that precede real movements. The market shows its intentions through behavior long before it expresses them in big, obvious moves. People often ask, how do you spot these subtle shifts? The truth is, you have to pay attention to the relationship between price and pressure. Look at how price behaves when it meets selling. Does it fall easily, or does it hold up? Look at how price responds when buyers step in. Does it jump, or does it remain sluggish? A wave begins when the relationship between effort and result changes. If heavy selling produces very little downward movement, something is changing beneath the surface. If strong buying doesn't push price higher, that's also a shift. You're watching the tension between buyers and sellers, and when that tension changes tone, the wave begins. Quietly, softly, like the ocean pulling back before it surges. And ask yourself this, why do most traders only react to the big moves? Because big moves make them feel safe, even though they offer worse entries. A huge breakout candle makes them think, now it's real. But the truth is, the move was real long before that candle. The big candle is simply the crowd waking up. But the early shift, the drying selling, the tightening range, the refusal to break support, is the smart money positioning itself. Those early operators see something changing, and they move in before the crowd confirms it. That's what makes subtle shifts so valuable. They give you a seat before the theater fills up. The market rarely flips from bearish to bullish or bullish to bearish all at once. Instead, it transitions through a period of hesitation, friction, and balance. This transition often appears as nothing more than sideways movement. Traders glance at it and say, the stock is boring. Nothing's happening. But something is happening. The wave is gathering strength. The tug of war is shifting. And if you ignore that phase, you will always enter late. That sideways movement can be the earliest hint that pressure is equalizing, that the dominant force is weakening, and that the opposing force is preparing to take control. Subtle shifts also appear in volume patterns. Maybe the selling volume was high for weeks, and suddenly the volume shrinks. That's not just a coincidence. It's the market telling you sellers are losing interest. Or maybe the volume increases slightly while price barely moves down. That's the market telling you buyers are stepping in quietly, absorbing supply. You have to read these clues without dramatizing them. They're not guarantees, but they're signs, early signs, that a wave is preparing to rise. Another place these shifts appear is in failed breakdowns and failed breakouts. If price should logically continue in one direction but fails to, that failure is a whisper of changing conditions. A stock that breaks below support but immediately crawls back inside the range is showing subtle strength. A stock that breaks above resistance but sinks back in is showing subtle weakness. These failures often precede major turns, not because of the move itself, but because of what it reveals about underlying pressure. When the obvious move fails, the early wave begins. The trader's job is to develop sensitivity, not to noise but to behavior. Noise is loud but meaningless. Behavior is quiet but revealing. A stock's behavior tells you what the big operators are doing, and they move early, not late. They feel the wave before it forms. They sense the imbalance before it becomes visible, and they act before the crowd understands what's happening. When I say early entries rely on probability and discipline, not prediction, I'm talking about the heart of real trading, about the difference between behaving like a professional speculator and behaving like a hopeful gambler. Most traders think their job is to predict what the market will do next, to call tops, bottoms, turning points, or explosive moves. But the market doesn't reward the one who predicts, it rewards the one who prepares. It rewards the trader who sees the odds tilt slightly in one direction and has the discipline to act. Not recklessly, not emotionally, but with controlled risk and a clear plan. You ever notice how the urge to predict comes from ego, but the urge to follow probability comes from experience? When you rely on prediction, you tie your confidence to being right. And when your confidence is tied to being right, you start forcing trades, ignoring warning signs, and holding positions long after they've proven you wrong. But when you rely on probability, your confidence comes from your process. You don't need to be right every time. You just need the odds to be in your favor enough times that the math works out. Probability gives you flexibility, prediction traps you in stubbornness. Think of early entries. By definition, you're stepping in before the full move appears. That means there won't be dramatic candles confirming your idea. You won't have the cheerleading of the crowd. You won't have certainty. What you will have, if you're disciplined, is a collection of clues: shrinking selling pressure, tightening ranges, higher lows, failed breakdowns, increasing volume on small advances. None of these signals guarantee a huge move, but together they tilt the probability in your favor, and in trading that's all you ever need. Ask yourself something: when was the last time you waited for absolute confirmation before entering a trade? Did it help you, or did it put you in late, with a worse price and more risk? Waiting for a breakout that everyone can see feels safer emotionally, but it's often worse mathematically. Early entries feel uncomfortable because they lack dramatic confirmation, but that discomfort is exactly why they work. The crowd hasn't flooded in yet. The big wave hasn't revealed itself. The risk is small because your stop is close. And if the move fails, your loss is minimal. That's probability and discipline working together. Prediction, on the other hand, is emotional. It's tied to desire. When you predict a move, you want the market to validate your opinion. You start seeing what you want to see. That's dangerous. A disciplined trader doesn't fall in love with ideas. They fall in love with good setups. Setups with favorable odds, even if they don't play out every time. Discipline means you enter because the structure is right, not because your ego whispers that you'll look smart when the market moves. There's another truth here: trusting probability allows you to think in series, not single events. Every trade is just one in a long chain. Whether it wins or loses matters less than whether the chain is profitable over time. Early entries give you a mathematical edge because they allow you to enter with tight risk. If you take 10 such trades and only 4 become big winners, you'll likely still come out ahead because your losses were controlled and your gains had room to run. Isn't it easier to trade when your goal isn't perfection, but consistency? Discipline is what keeps probability alive. Probability is what makes discipline worthwhile. Without discipline, early entries turn into reckless stabs. Without probability, discipline feels like needless restraint. Together they form the foundation of long-term trading success. Discipline is saying, I will enter only when these conditions are met. Probability is saying, even if this trade doesn't work, the process still makes sense. That mindset frees you from emotional sabotage. Another thing about prediction: it tries to tell the market what to do. Probability listens to what the market is already whispering. Prediction makes you impatient. Probability makes you observant. Prediction pushes you to act too early or too late. Probability tells you when conditions are favorable and when they're not. Most traders confuse prediction with confidence, but real confidence comes from knowing you can survive dozens of trades because your system tilts the odds your way and your discipline keeps you from blowing up. Early entries become dangerous only when a trader refuses to honor their stops. That's where discipline proves itself. If you enter early and the market doesn't follow through, you must cut the trade without hesitation. No debate, no negotiation, no hoping. Discipline is the braking system that prevents probability-based trading from sliding into chaos. It's the part of trading most people hate because it forces them to accept small, frequent losses. But those small losses are the price you pay for catching the early stages of real waves. Would you rather pay little and often, or a lot all at once? When you focus on probability, you stop caring whether any individual trade becomes a winner. You care only about whether the setup made sense. This reduces emotional pressure, which improves clarity, which improves execution. And oddly enough, once you stop needing to be right, you start seeing the market more clearly. You start recognizing the early shifts without forcing them. You start entering positions calmly, without fear, because you're no longer predicting. You're responding. A trader who focuses on probability and discipline becomes dangerous in the best possible way. They stop chasing moves. They stop needing validation. They stop panicking at small losses. They start catching waves earlier, holding them longer, and stepping aside quickly when the market isn't aligned with their system. They grow into the kind of operator who can stay consistent in a world built on uncertainty. When I say deep psychological shifts, fear easing, confidence returning, create early currents. I'm talking about the market's undercurrent, the part that moves long before price makes any dramatic statement. Most traders stare at the charts and see only the surfacey candles, patterns, indicators. But underneath all that, the real engine of any market move is psychology. And psychology doesn't flip like a switch. It changes quietly, gradually, almost invisibly at first. If you can sense those early shifts, you can catch the move before the crowd even suspects it's forming. Let me ask you something right now. Have you ever watched a stock that's been dropping hard, dragging fear across the entire community, and then suddenly the panic just stops? Not because there's good news, not because buyers are rushing in. It just stops. People stop dumping their positions. Price stops reacting violently to small sell orders. The mood changes even though the chart barely moves. That's what I mean by a deep psychological shift. Fear doesn't vanish with a headline. It fades internally, through exhaustion, through capitulation, through the market's collective moment of, I've had enough. And once fear eases even slightly, the current beneath the price begins to turn. Fear is a heavy force. It pushes markets downward with remarkable speed. But fear also burns out faster than most traders expect. You can only scare people for so long before the sellers run out, and the moment fear exhaustion sets in, the selling loses its grip. Price may still be low, volume might still look normal, but the tone changes in a subtle way. Downward moves shrink. Reactions become softer. Support levels start holding instead of breaking. Most traders ignore these signs because they're waiting for something loud and obvious, but by the time loud arrives, the early current has already been flowing for days. On the other side of the spectrum is confidence. True confidence in a market or a stock doesn't show up with giant green candles. Those candles are the expression of confidence, not its origin. The real shift happens when buyers stop acting timidly, when they start stepping in earlier, when they absorb sell orders without hesitation, when they're willing to test a level again and again until they begin to overpower the sellers. This change is quiet at first, almost shy. But confidence builds on itself. Every time price refuses to fall, a little more confidence returns. Every time volume increases slightly on small upticks, confidence grows. Eventually, confidence builds enough momentum that it becomes visible to everyone. But the trader who can sense it early gains the advantage. Think about moments when the market should go down and doesn't. The news is terrible, sentiment is negative, the crowd is fearful, yet price holds. Why? Because deep beneath the surface, confidence is beginning to replace fear. Traders with a longer view start accumulating positions quietly. Short sellers lose conviction. Swing traders test small buys. These behaviors are psychological first, price-driven second. And the earliest clues show up in behavior, not in dramatic price action. Ask yourself this. How many times have you looked back at a chart and said, "I should have known something was changing"? That's because the psychological shift was present, but you weren't looking for it. You were watching for breakouts and big moves, not the mood of the market. The mood tells you more about coming waves than any single indicator ever could. Psychological shifts often show themselves in the speed of reactions. During fear-driven markets, every bounce gets sold aggressively. But when fear starts easing, those aggressive reactions slow down. Sellers become hesitant. They start taking profits sooner. They stop pushing price to extremes. That hesitation, so small most traders don't even notice it, is a powerful signal. It means the emotional energy behind the downtrend is fading. And when emotional energy fades, trends weaken. Similarly, in strong uptrends built on confidence, you'll notice that dips are bought quickly. Not dramatically, not with loud volume spikes, but steadily. Buyers act like they trust the asset. They don't wait for perfect entries. They don't panic at small pullbacks. Their steady presence forms the base of the wave long before the price lifts off. If you learn to observe how buyers behave during dips, you'll begin to sense the early confidence that drives real moves. Another place psychological shifts reveal themselves is in volatility. Fear-driven markets are volatile because emotions run wild. Confidence-driven markets tighten up before expanding again. When volatility shrinks during negative sentiment, something is changing beneath the surface. Tight ranges after big fear events are a sign that the emotional tide is shifting. It's the calm before accumulation, and while other traders complain that nothing is happening, the truth is that something important is happening. It's just happening psychologically, not visually. Deep currents also show themselves in the behavior of failed moves. A failed breakdown is more than just a price event, it's a psychological event. It tells you that sellers attempted to push price lower but couldn't. That inability creates doubt among sellers and confidence among buyers. Doubt and confidence. These are psychological currents, not technical ones, but they turn into technical moves soon enough. The market is a mirror of collective emotion, and failed moves often reflect that emotion changing direction. Most traders think psychology is too abstract or too subjective to trade from. But in reality, the market expresses psychology through subtle patterns you can observe if you train yourself to look for them. The intensity of selling, the willingness of buyers to step in, the speed of reactions, the firmness of support, the resilience of price, all of these are psychological tells long before they become chart patterns. And once you start reading these deeper currents, you'll begin to sense the early waves that others only recognize after they've already risen. When I talk about deep psychological shifts, fear easing and confidence returning, creating early currents in the market, I'm pointing to something that most traders overlook because they're hypnotized by the surface. They watch candles rise and fall, stare at indicators flashing signals, and obsess over patterns that everyone sees at the same time. But the market isn't moved by lines on a chart, it's moved by emotion, conviction, doubt, hesitation, boldness. The real turns happen inside people's minds before they ever appear in price. And if you can feel that shift before it becomes obvious, you position yourself long before the crowd even wakes up. Let me ask you a question right off the bat. How many times have you looked back on a chart and said, "I saw the signs, but I didn't trust them"? That's what happens when the psychological shift was there, but you weren't tuned into it. The market always reveals its emotional tone before it reveals its full price movement. Fear doesn't disappear with a big green candle. Confidence doesn't arrive with a breakout. Both start forming quietly, subtly, in the behavior of traders long before the chart shows anything dramatic. Imagine a stock that's been sliding for weeks. Fear is high, sentiment is terrible, and traders are exhausted from watching red day after red day. Then it happens, the selling pressure suddenly starts to soften. Not enough to make headlines, not enough to thrill anyone, but enough that you notice the reaction to sell orders is a little less violent. Price stops falling aggressively. The candles shrink. A little stability appears where there was none before. That is fear beginning to ease, not loudly, not visibly, But internally, in the collective psychology of the market, fear-driven selling requires emotional fuel, panic, uncertainty, shock. But that fuel burns quickly. People dump shares in a rush, and when they run out of shares to dump, the fear starts to fade. The shift is gradual. Seller exhaustion sets in. The downtrend doesn't reverse immediately, but the tone changes. Price stops collapsing on small pushes. Support levels start holding longer. Volatility cools from frantic to steady. These tiny changes are the early currents forming long before the wave turns upward. On the other side of the spectrum, confidence doesn't roar into the market. It walks in quietly. True confidence comes long before the chart breaks out. It starts when buyers no longer wait for the perfect entry. They step in at levels where they previously hesitated. They absorb small dips. They show interest in spots where earlier they showed fear. And this renewed willingness, this subtle shift in behavior, creates steady pressure that builds under the surface. Confidence feeds on stability and expands slowly, like a tide rising inch by inch. Price action reflects these psychological changes in little ways. A trend that once made lower lows suddenly starts making equal lows. A chart that used to break support easily now clings to it. Down days shrink. Up days last a little longer. Each clue is minor on its own, but collectively, they paint the picture of a market whose emotional tone is shifting. Traders often miss these shifts because they're waiting for proof. But proof comes after the move, not before it. Ask yourself again, do you watch the mood of the market, or only the motion? Because the mood changes first. Market mood appears in the behavior of dips and rallies. In a fearful market, every rally is sold aggressively. But when fear begins to ease, those sell-offs become weaker. Sellers begin taking profits earlier. They lose confidence in pushing price to new lows. That hesitation isn't just price stalling, it's psychology weakening. And once fear loses momentum, price naturally steadies. Confidence has its own early signs too. Look at how dips behave. In uncertain markets, dips stretch deeper than expected because buyers hesitate. But when confidence returns, even modest buying creates stability. Dips become shallower. Price doesn't fall as far. Buyers react faster. They become more courageous, even though the chart may still look dull. This quiet resilience is one of the strongest early signs that confidence is returning, even if the crowd hasn't recognized it yet. Volatility is another psychological tell. High volatility often marks fear. But when volatility compresses after a long decline, that's a psychological shift in disguise. Traders interpret consolidation as nothing happening, but they're wrong. Something is very much happening. Emotion is cooling. Fear is fading. The market is stabilizing. And when emotions settle, currents shift. That compression often marks the birthplace of accumulation. Failed moves are a big part of psychological shifts too. A failed breakdown is not just price bouncing, it's sellers losing conviction. That failure plants doubt in the minds of bears and hope in the minds of bulls. Both emotions feed new behavior. Traders start watching levels more closely. Short sellers tighten their stops. Early buyers experiment with small positions. On the surface, price may look flat. Beneath, the emotional current is turning. All of this leads to the same truth. Psychology moves first, price follows. Fear pulls markets down quickly, but when fear weakens, its grip loosens in very specific ways. Confidence builds slowly, but its first signs appear in subtle resilience rather than big rallies. These early psychological currents are invisible to anyone looking only for big moves, but if you train your eye to see hesitation, firmness, exhaustion, and quiet strength, you'll spot the shifts long before the wave rises. And when you can read these emotional changes, you start to sense the beginnings of a move before the chart makes its announcement.